Hi, I'm Linda Eedes, and a very warm welcome to today's webinar, which is titled Opportunities for South African Investors, Bonds, Equities, and Beyond. Now, South Africa's economic growth may be stuck in low gear, but the good news is we're here today to tell you that that doesn't mean that investors are without opportunity. In times like this, it calls for some fresh thinking, discipline, and always a long-term perspective. But today we're going to explore where the real prospects lie across the asset class spectrum. So from equities to bonds, and how investors can position themselves for sustainable investment success despite a challenging environment. Now, to unpack all this, I'm joined today by two of Foord's experienced portfolio managers, Farzana Bayat and Nancy Hossack, and they're going to share their insights and strategies for building resilient, future-proof portfolios. So over the next hour, we're going to delve into some of our best investment ideas. We're going to answer some questions. I'm going to put a poll to you, so keep a watch out for that. And hopefully we're going to leave you with renewed confidence in the opportunities that are available right here on our doorstep in South Africa. But let's start with a healthy dose of reality. Now, what we're looking here at is how foreigners have been disinvesting from our equities and bonds over the last few years. So this is portfolio foreign investment as a percentage of GDP. And you can see that over the past 5 years, we've seen steady outflows from both assets such as equities and bonds by foreign investors from our assets. And that's obviously bad news. So the foreigners are not feeling quite so confident about their prospects investing in South Africa. But the consequence of foreigners selling is that both earnings yields and bond yields have both ticked up. So this looks at the earnings or the yields that you get relative to the price. It's sort of a measure of the value there. And here we're showing the 5 to 10-year bond yield. And next to that, we're showing the earnings yield for the FINDI index specifically. So that's the financials and industrials index. We've actually stripped out resources because they are so volatile and they tend to muddy the waters a bit. But we want to see how the average South Africa incorporated financial and industrial business is faring. And what is quite interesting is you can see that sort of from around the time that foreigners began to disinvest, that earnings yields and bond yields have been moving in tandem. So now there's something quite unusual about that, and I'm going to leave that to Nancy to unpack what that means for us later on in the situation. But before she does that, we're going to discuss the fixed income opportunity set with Farzana. Now, Farzana, if we look at bonds at the moment, I think there are three big questions which are on our mind right now. The first is that we're seeing very, very high levels of government debt around the world, both here locally in emerging markets and in places like the US. So the first question I think we want to wrap our heads around is what the consequences of that will be, particularly in terms of bond yields. You know, will investors demand much higher yields than they have historically for the higher risk of lending to these very highly indebted governments? Secondly, if we look at bonds as an asset class, of course, we've got different options within that. We've got the option to invest in nominal government bonds, but we can also invest in inflation-linked bonds. So something I'd like you to unpack, please, is how do you pick one versus the other, and which offers better value in today's environment? And then lastly, I think it's important that we check in with you on what's going on in the local credit market. Lending to corporates was always deemed as being more risky than lending to governments, so you got a higher yield. But today, we're seeing some credit bonds are yielding less than government bonds. So we need to understand how sustainable that actually is. So let me hand over to you to walk us through some of those issues on the fixed income side.
Thank you, Linda. Yes, so I'll address those three questions. So let's start with the debt burden. So, this is a topic we've raised before in the South African context, and the US and most of the developed world are also sitting in a very precarious position In the US, for example, they collect about 5 trillion in revenue and they spend about 7 trillion. So that's a consistent 2 trillion shortfall every year. And you can see how that jaws has opened up post-COVID, similar to what we saw in South Africa under the Zuma era, where spending just got out of control. And when that happens, it becomes very difficult to manage and to close that gap again. In the US, you would have seen Elon Musk came in earlier on with Doge. Doge came and went without any significant reduction in spending. And it feels like the political will to actually tackle the spending problem head on in the US seems to have dissipated. And rather, they want to grow their way out of the problem. So they want to cut interest rates and stimulate growth. So we think this lack of fiscal discipline that you're seeing across both the developed as well as the emerging markets is something that does concern us as fixed income investors. And what makes this debt dynamic even more concerning is the end of the ultra-low interest rate era. So for more than a decade post the global financial crisis, interest rates were close to zero, which meant that debt service costs were almost negligible. So it didn't really matter what your debt burden was. But now that rates have normalized, that debt has a real cost. In the US, they spend about 20% of their revenue just on servicing interest. And that means essential services like healthcare, education, etc., are all getting squeezed. So, we think this debt burden is not benign and the risks are greater than people appreciate. And we are starting to see cracks in the world's safest markets. In April, we had a tariff-induced risk-off event. And generally what happens is money flocks to the dollar and the dollar strengthens. But this time around, we saw the opposite materialize, where bond yields actually went up and the dollar weakened. And that raises some serious questions. It's, I think people are asking, is the dollar still seen as the ultimate safe haven? Can they continue running these persistent deficits without any consequences? We think this was a warning signal. The safe haven behavior didn't materialize, and the market is questioning the sustainability of their fiscal position. In fact, the behavior here is more like a country under stress or more like an emerging market, not the world safe haven country. So on the back of this, we are cautious long duration bonds. We think this debt problem is not going away, and the markets are waking up to this reality. If we then turn to South Africa, we face many of the same challenges. Over the past 15 years, our debt has ballooned sixfold. We've gone from under 1 trillion in debt to almost 6 trillion, with very little growth to show for it. And in fact, if you look at the budget saga that we had this year, where we had 3 versions of the budget, it just underlines how serious that strain has become. Your tax revenues are under pressure, and there's not much scope to squeeze households and corporates any longer. And on the other hand, your expenditure pressures are building, particularly in frontline areas like your education, your healthcare, etc. So it's likely that we're going to continue to be running these persistent deficits and sitting with high levels of debt. And then similar to the US, out of every 100 Rand that we collect in tax revenue, 22 Rand goes towards servicing debt. And that once again means that less money for your essential services, which is why those pressures are building up on the expenditure side. Now, in order to stabilize our debt, we have 2 levers. We either need more real GDP growth or we need higher inflation, because both of these make up nominal GDP, which is the denominator of your debt to GDP metric. So if you look at growth, for example, in South Africa, over the past 10 years, growth has been dismal. We've grown at 0.7% per annum, and that's very poor for an emerging market. And if you look at current forecasts, they're also not looking that much better. We're sitting at below 1.5%. And if we're serious about stabilizing our debt, we actually need sustained real GDP growth of at least 2.5% per annum. And in the absence of, some deep structural reforms and significant policy shifts, it's unlikely we're going to get there. And then if you look at inflation, the SARB is wanting to target a lower 3% target. And if inflation is low, it means that your nominal GDP is low. If your denominator of your debt to GDP is low, it means your debt metrics go up, which then means risk premiums go up, which then means debt service costs go up, and you end up in this debt trap. So, given these constraints of weak growth, rising debt, We are also cautious on long duration bonds in South Africa. We think there is still significant risk there, and these are not being reflected in the bond yields at the moment. And then turning to Linda's second question, inflation-linked bonds versus nominal bonds in South Africa, where we see value. So in this chart, we're showing real yields of 5 and 10-year inflation-linked bonds. And you can see that when this asset class was first introduced in the early 2000s, they offered very attractive yields of 5-6%. We then had this massive rally driven by your liability-driven investment portfolios, and real yields got to negative on 5-year and below 1% on 10-year. And then over the past 10 years, that rally has fully reversed and yields have been steadily climbing higher. Now, this re-rating in real yields would have hurt investors, particularly investors invested in passive inflation-linked bond funds, because those carry a very high duration. So to put it in perspective, real yields have gone up 400 basis points, and on a 10-year duration, that's a 40% capital loss that investors would have suffered in that period. And that's also why it is an asset class that's out of favor. But we think, the silver lining, the good news is real yields are now at multi-decade highs. Today, you can lock in a 5% real yield on a government-backed instrument. That is a very compelling opportunity, a very rare opportunity. And we also think what's not appreciated by the market is inflation-linked bonds are the only asset class that actually guarantee you a real return. There's no asset class that does that. So when you do your portfolio construction and you're modeling expected real returns of your different asset classes, your equities, bonds, property, etc., you rely heavily on forecasts, assumptions, whereas with your inflation-linked bond, there's no guesswork. You know what you're getting. So we think, any fund that has CPI as a benchmark, it's a compelling building block. And in this environment of rising debt, policy uncertainty, it is one of the best risk-adjusted returns available in the market right now. Then, apart from high real yields, break-evens also favor inflation-linked bonds. Now, just to recap, what is break-even? Break-even is the inflation rate at which a nominal bond and an inflation-linked bond will give you the same yield. If inflation ends up being higher than break-even, then your inflation-linked bonds will outperform your nominal bonds and vice versa. Currently, you can see break-evens have rallied a lot, and they're sitting at about 3.5% on 5-year, and they've come down from elevated levels of 5-6%. We think this is very optimistic. The market is basically pricing in a whole new low inflation paradigm with no risk premium. And we think that the balance of risks are asymmetric. So if inflation ends up printing higher, your inflation-linked bonds will do well and your nominal bonds will get hit. And if inflation ends up printing on the lower end, then you still will get a 5% real return on your inflation-linked bond. So, we like that sort of trade-off where you get good upside and meaningful downside protection. Here we're just looking at how cash, nominal bonds, and inflation-linked bonds stack up in different inflation environments, right? We're looking at a 3% inflation, 4.5% inflation, 6% and 10% inflation. And the inflation is represented by the blue bars in the chart. So we'll start with inflation-linked bonds. And here the real yield is represented by the red bars. So you can see that it doesn't matter what happens to inflation, your inflation-linked bonds will give you a consistent real yield of 5% across all scenarios. So you get full inflation protection. As inflation goes higher, your all-in yield increases, so you do very well in a high inflation environment. If inflation's at the lower end, you're still actually getting a yield in line with nominal bonds. Then if you look at nominal bonds, here the real rate is represented by the brown bars. So you can see that if you want to get a 5% real on a nominal bond, you actually need a very low inflation scenario. You need 3% inflation. As inflation drifts higher, your real yield on your nominal bond, it gets eroded. So if we end up in a 4.5% inflation scenario, which is very likely, it's where we've been for the past couple of years, then your real and your nominal bond will be 3.6%, where your inflation-linked bond will still be 5%. And as inflation gets higher, if you end up in a 10% world, your real yield will end up being negative. So you can see that nominal bonds actually carry a lot of inflation risk as you get no protection for inflation. And then lastly, we're going to look at cash. So the real yield on cash is shown in the gray bars. And we basically assume that the SARB will target a 2.5% to 3% real yield. And in a low inflation environment, they might target the lower end of 2.5%. And in a very high inflationary environment, they might be a little bit cautious and not wanting to raise rates too much and live with a slightly lower real. But we want to draw your attention to the gap between cash and inflation-linked bonds. So if a floating rate instrument that's linked to JIBAR needs to match the yield of an inflation-linked bond in any of these scenarios, it's got to pay you JIBAR plus 2 to 3%. And the problem with that is in the current environment, if you look at the credit market, the income market, there's very little that can actually get you to JIBAR plus 2 to 3%. If we lend to, for example, a single A-rated corporate, what we'll likely get there is JIBAR plus 150 basis points, and that's also with a lot of credit risk. So, we think that in the current environment, inflation-linked bonds are positioned to give you very attractive yields with not a lot of risk. And in a multi-asset fund, it's actually quite a compelling alternative to your nominal bonds and to income or floating rate type or even credit type instruments. And then, Linda, to your last question about the South African credit market, and to your point, spreads have compressed significantly over the past couple of years, and let's unpack what's going on there. So in 2017, if we had to lend to a bank or a corporate, we could earn an additional yield above government of about 120 to 150 basis points. So that's reasonable and worthwhile to take on a bit of credit risk. That is compressed all the way down to negative 10 basis points for banks. So we get paid less lending to a bank than lending to government, and a range of about, say, negative to 40 basis points for corporates, depending on the rating of the entity. Now, that's very, very low. So what's driving this? There's a demand-supply imbalance in the credit market. So on the supply side, credit issuance have been very weak, and that's because growth in South Africa has been poor. So, there hasn't been a lot of capex spend, no major expansion. Your corporates are just not really needing to borrow. And then at the same time, on the demand side, you've got this explosion of fixed income investors due to the surge in income funds. If you looked 15, 20 years ago, there were a handful of income funds. Now there's 150 plus income funds. And all of them are chasing the shrinking pool of assets. So it's too much money chasing too little paper, and that's been driving the spreads lower. And it's actually gotten to a point where AA rated corporates can sometimes pay you less than government. And, so people are accepting a lower yield for taking on more risk. So that just makes no sense. And we think it's just textbook example of mispriced risk. So for us, we are light on credit, and we rather preserve capital than stretch for yields that are not justified. And here we thought we'd just give an example of a recent credit issuance just to show how distorted the pricing has become in the credit market. So this is CUP. It's a local corporate, a single A-rated corporate, and they came to market and they borrowed for 5 years at JIBAR plus 153 basis points. Now, on the surface, you might think this looks reasonable, but the fundamentals tell a very different story. So, CUP, their debt levels have ballooned significantly to over 10 billion, while their market cap has dropped to below that, to 6.5 billion. Many of their business units have been underperforming. Their free cash flows turned negative. The share price has collapsed from 9 Rand to under 2 Rand. So you can see this is clearly not a healthy credit. And historically, for a credit with these sort of stress signals, we would have expected this to price at JIBAR plus 250 to 300 basis points, but the market accepted JIBAR plus 153 basis points. And to put that in perspective, the government borrows at JIBAR plus 115 basis points. So the market accepted 40 basis points more for significantly more risk. So, just no compensation for risk. So we are very cautious on credit, very light on credit. We believe it's better to preserve capital in safer assets and wait for spreads to normalize at a later, and then invest at a later stage. But where we are seeing value is in like the structured note space, but this normally only materializes when you're in a risk-off event or when there's a market dislocation like we saw in April last year. So when the market panics and spreads blow out, there are opportunities to lock in very attractive yields on high quality names. So an example of that is a Quanto credit linked note. So that's basically where we've taken an offshore South African government bond, wrapped it in a local credit-linked note where the interest rate risk as well as the currency risk is fully hedged. And we've been able to do this at JIBAR plus 300 basis points. And with JIBAR sitting at 7, that's about a 10% yield. Now, that's a very attractive yield for an asset that has low credit risk and low interest rate risk. But like we said, these are not everyday opportunities. You have to be patient. You also have to be ready to act when the opportunity comes. So I think to sum up, we are cautious traditional credit, which is priced to perfection, but we are rather waiting for the market to give us opportunities where we can then get paid appropriately for that risk. And then we'll just, based on our views, where you can see that we're cautious on fixed rate bonds, we're cautious on credit, and we're bullish on inflation-linked bonds. We'll just see how that's reflected in the Foord Flex Income Fund. That is our multi-asset income fund. So at the moment, we have a 90-10 split of local versus offshore paper. On the local side, we have predominantly floating rate assets. And within that floating rate assets are those JIBAR plus 3% type exposure. We also have liquid cash available for any opportunities that might come. So we have some flexibility there. We have no fixed rate bonds. We sold the last of it during this recent rally that we saw post the inflation target, which caused break-evens to compress. We like inflation-linked bonds, so we hold about 20% there. And then on the offshore side, we also like US TIPS, that's US inflation-linked bonds. We have about 6% exposure there. And we like that because break-evens in the US are also very compressed, so the market's not really pricing in inflationary risks on the back of the tariff increases. So we think that with the US TIPS, if inflation stays sticky because of the tariffs, you're going to benefit. And then there's also pressure in the US for rates to fall. And if that happens, you'll also benefit from the real rate falling. And then on the credit profile of the portfolio, like I mentioned, we light on credit. So at the moment, we hold 90% in bank and government paper, very little corporate paper. Our interest rate risk in the fund at the moment is under 1 year. But importantly, we don't have fixed rate interest rate risk. We have predominantly inflation-linked interest rate risk. And we're comfortable with that because because real yields tend to be a lot more stable than nominal yields. The yield on the fund at the moment is 9.2%, which is cash plus 2%. And if you compare that to the government bond curve at the moment, that's equivalent to about a 9-year fixed rate government bond, but we're getting this yield with much lower interest rate risk. So to sum up, the fund is conservatively positioned to protect capital in any risk-off environment. We have flexibility to take advantage of opportunities. We have a lot of inflation protection built in the fund, and it's geared towards giving you a smooth return payoff profile. And then we wanted to touch on, given that we like inflation-linked bonds, we wanted to talk about a new fund that we launched in September last year. It's the Foord Inflation-Linked Income Fund. And we set up this fund to meet a very specific need in the market. We found that investors wanted reliable inflation protection, but in order to access that, they were investing in passive inflation-linked bond funds. And the problem with that is these funds sit with a very high duration. And because they have a high duration, they end up giving very volatile returns, significant drawdowns, and they haven't been able to reliably give the client consistent CPI plus returns. So we thought in order to solve for that problem, we would launch a fund that will target a shorter duration of 2 to 3 years. And with a shorter duration, we can then lock in real returns with more certainty, avoid the big drawdowns, and give more reliable inflation plus returns. So for example, if we targeting, if the fund is currently yielding, say, CPI plus 5%, and if real yields blow out by 100 basis points in either direction on a 2-year duration, we know the fund can roughly deliver CPI plus a range of 3 to 7%. So it's a narrower range, but something we feel confident we can deliver with a lot more certainty. And the positioning of the fund at the moment, we hold predominantly 3- and 4-year government inflation-linked bonds. There's a very good yield on those. The curve is quite flat beyond that. We hold some bank inflation-linked bonds where you get a bit of a yield uplift. And then we just want to highlight to you how this fund compares to a passive fund. So they're both giving you similar real yields of about roughly 5%. But the Foord inflation-linked income fund is able to do that with a significantly lower duration, a 3.5-year duration, where the passive fund is 9.5 years. And in fact, we're a bit long at the moment. We aim to bring this down to about 2.5 years. We also, importantly, have no long duration bonds in this fund, where the passive funds have more than 60% in long duration bonds. So we're avoiding, that long end, which is very expensive and where you get a lot of volatility. So just to sum up, we think it's a compelling building block. Any multi-asset fund that has CPI as a benchmark, this is just a natural fit. Internally, we're using it in our multi-asset funds. As break-evens have been compressing, we've been rotating out of nominal bonds into these shorter duration inflation-linked bonds. And we think any investor who wants inflation protection, reliable CPI plus returns, low downside, it really is something compelling for them to consider. I'll end off at this point.
Thanks, Farzana. Now, you spoke about inflation ticking back up from the low levels we're seeing today. Some might argue that with the proposed new inflation target, sort of bringing that down to 3%, that could potentially keep inflation on the lower end. What are your thoughts on that?
Yeah, so Linda, the timing of this target, inflation target talk has coincided with the cyclical low that we've seen in inflation. So strategically, it makes sense, but we think execution is going to be difficult. And the SARB has basically jumped the gun and unilaterally decided to go and target this low 3%, even though National Treasury has indicated that the decision ultimately rests with them, and it's a decision that shouldn't be rushed. And inflation targets have real fiscal consequences. They affect things like budget planning, they affect wage negotiations, they affect debt metrics. If you take nominal GDP, for example, if inflation is low, then your nominal GDP is low, which means in your debt to GDP calculation, if your denominator is low, your debt metrics go up. So that's something that shouldn't suit National Treasury. If anything, they would want a higher level of inflation in order to stabilize the debt. Then secondly, SARB is relying on inflation expectations to fall once they announce a new target. And it doesn't quite work like that. Inflation expectations are driven by past inflation, not some future target. So, even in 2017, when they decided to target the midpoint of the target band, the 4.5%, it took 4 years for inflation expectations to anchor lower. And then if you look at our track record, over the past 20 years, inflation has been above 3%, 95% of the time in South Africa. And if you compare that to the US, they've been above their 2% target 60% of the time. So they have a natural anchor around their target, where for us it will be a complete structural shift from historical norms. And then, we have structural issues like administered prices, public sector wages, which are running well above inflation. If you look at your tariff increases and even the wage negotiations with the unions, they're all well above 6%. And these are politically sensitive, so you do need political buy-in. And then lastly, I would say, the SARB has given National Treasury the savings narrative and said that you will save almost R1 trillion in debt service costs with the lower target. But the problem with that is we've already borrowed for very long periods of time at very high rates. We have one of the longest debt maturity profiles in the world. So, if we borrowed at 13% and we now target a 3% inflation, that means we've locked in borrowing costs at 10% real. So we think, rather wait for that debt maturity profile to shorten and then maybe implement the target at that point. Or if they do want to save on debt service costs, change your funding strategy, issue more short-term paper, issue more floating rate paper, and you can do that without a target. You don't need a target. So we think the target is ambitious, political buy-in is not quite at the same pace as the SARB would want it, and the fiscal environment doesn't currently support it.
Okay. Now, Farzana, you mentioned that this is quite a tactical opportunity in the sense that real yields are very high at this point in the cycle. So there will be investors who want to actually take advantage of that and invest directly. But of course, the question has been asked, what is a sensible allocation at this point in the cycle? And what would your markers be to actually reduce that position over time?
Yes, so, real yields, while they are 5%, they will move with the market. Though having said that, they have been fairly stable around 4.5% to 5% over the past year or two. So if a client buys an inflation-linked bond at a real yield of 5%, and that real comes down to 4%, then at that point, their new real yield is now 4%, and they've got a mark-to-market profit on the asset. And they can then make a decision and decide, are they still happy with the 4% real, or do they want to trim that exposure? So it becomes a tactical asset allocation decision. And I think in our minds, in a multi-asset fund, if your real is between 4.5% and 5%, I think a meaningful allocation of maybe 10% would make sense. If it drops to 3.5%, I think you would want to trim. And if it falls below 2%, you would probably not want to have anything at that point.
Okay, makes sense. But I would say, Nancy, that a lot of the investors on the call possibly prefer to access that within a multi-asset fund. So they want to leave that to us in terms of managing that tactical exposure. So could you give us a sense as a portfolio manager of, for instance, the Foord Balance Fund, how are we actually incorporating inflation-linked bonds in our multi-asset funds at the moment?
Yeah, I think that it's a very good question, Linda, because I think the slide that you started off with, which was to show these very real yields in both the bond space and the equity space, is kind of the starting point here. But as a multi-asset fund manager, we're looking at that 5% real yield and saying, hold on a second, that's a really amazing opportunity. And it's actually a very high bar for us as portfolio managers to allocate against, right? If we're looking at the kind of equity universe, if I can lock in a 5% real yield for balanced funds, I mean, I can go to the beach and relax after that. That's actually, and it's kind of sleep easy, right? There's the inflation risk is reduced. And so actually very difficult to look at other kind of asset classes against that. I think that when we sat down to discuss what we wanted to talk about today, that was actually really the starting point is, well, then how do equities kind of match up to that? And I'll speak a little bit more about that. But certainly that we agree from a multi-asset perspective that that's a fantastic opportunity. And so you would have seen that within our bond allocation in balanced funds, we probably would have been sort of 50-50 nominal bonds and inflation linkers historically. And that allocation is moving up to kind of 2/3 inflation linkers at this point because we think it's so attractive.
Okay, so let's talk a little bit about the earnings opportunities and the equity opportunities relative to bonds. Nancy, won't you take us through some of your views on the equity side?
Sure, I will do. So, I mean, I think as Linda mentioned, that with the starting point and the context of this chart being that we have seen this consistent disinvestment from the foreigners in South Africa from sort of 2018 on. And from that point, we've seen these earnings yields on the FINDI sort of tick up higher, and so too have the bond yields. And so actually, SA assets in their totality have become a lot more attractive from an earnings yield and bond yield perspective. What is interesting to note, and I think if you kind of have a look at the history of this chart, it will show you that actually that FINDI yield and that bond yield historically tracked much more closely together. So what you would have kind of made up for in terms of growth on the equity side, you sort of substituted on the bond side, you had kind of capital protection, and that those two sort of things the market kind of looked on as a substitute. What we've seen now is this, as I mentioned, very high real bar in terms of what bond yields are offering investors. And so too have we seen, the opportunity in SA equities increase, but that still is a very high real bar for the equities. And so I think what we wanted to do was just kind of delve into whether it still really makes sense to allocate to SA equities under this kind of different valuation regime with this big dispersion in those two numbers. before I delve into that a little bit more, I just wanted to compare this, so to compare these valuations and earnings yields with what we are seeing kind of globally. And another very big dispersion here when we compare the FINDI earnings yield to the S&P 500 earnings yield. And so what this chart is showing you is that actually for every R1 of earnings in South Africa, you're buying on the FINDI, you're having to pay almost double that if you had to buy a stock on the S&P. It's a very, very big differential. And actually, it's not a differential that has always existed. When you go back and you kind of look at the history, this type of difference in valuation is similar to that we actually saw in the kind of dot-com bubble in the US, this very big difference between the valuation levels. And just to go back to explain, I know that Linda did touch on it. The reason, again, that we're using the FINDI is that we're just trying to sort of give an idea of what we are seeing in the SA Inc. type space. So we've just removed the resources from the kind of CAPI index or the ALSI index. We have avoided showing those indices because they, at certain times in the cycle, have very, very high resource weightings. And what that tends to do is make that earnings yield a lot more volatile, and it's not giving you a good idea of what we're actually seeing from a kind of financial industrial SA Inc. opportunity set perspective. I think another interesting kind of dispersion that we're seeing at the moment is actually even within that FINDI index. So if we have a look at the sort of small and mid caps in South Africa, we are seeing that they in particular are offering us very, very good value relative to the kind of larger cap businesses. And I think part of that reason is what we started off talking about is that we've seen this big foreign divestment from South African assets in general. And certainly that's been exceptionally meaningful in that small to mid-cap index. Because what we typically see is that when South Africans divest from South Africa, they certainly do so first from the more illiquid stocks, and they might maintain kind of some of their trade in the larger cap, the banks, the retailers, those types of businesses. But certainly these smaller cap names are now offering incredible value. You know, if I compare something like the likes of Clicks, which is trading on a 25 times PE, to something like Rhodes Food Group, which is also a staple food-orientated business trading on a 7 times PE, it's actually quite rare for us within the South African context to see these very, very large dispersions within the index on particular stock valuations. So we would just say actually that the smaller to mid-cap stocks in South Africa we think are also kind of important and interesting opportunities at this point in the cycle. So, I mean, one thing that we get asked a lot about is, you know, we get asked a lot about the prospects for South Africa and growth and what that means for returns. And I want to spend a little bit of time just talking about how we build up returns, because I think a lot of investors tend to look at the growth rates in different economies and simply assume that higher growth means higher returns. And what we wanted to show from this chart is that, of course, growth and real growth, real GDP growth is a very important component of returns. But there's another very important component of returns, which is basically the valuation at which you're buying that asset, right? So in this context, what we've done is we've said, let's look at the starting yield on these assets. We've been talking a little bit about that in the previous charts, showing you where those yields are sitting and how they've materially ticked up. We actually think that those yields in SA assets are particularly high when we compare them to actually many of the other economies globally. So you can see that the US, when we take their dividend and share buyback yields, essentially if you buy the S&P 500, you're going to get some dividends out of that. Interestingly, about 50% of the kind of shareholder return that companies now give back to shareholders in the US is coming from share buybacks. So we've included those share buybacks. And you're sitting kind of south of that 2% level in terms of dividend and share buyback yields when you're looking at S&P stocks. If I compare that to what we see in SA, take the SA FINDI as an example, we're sitting at around kind of 4.5% in terms of just your starting yield. And then in terms of the SA small caps, we're sitting closer to the 5% level. And then to that, in terms of our expected real return, we add the GDP growth rate in the different countries. And we know for a fact that if we just take the last 10 years on average the US economy has grown well north of what we've grown at in South Africa. So we add 2.5%, which has been the 10-year average in the US to this in terms of the dark grey bars. And in SA, we add 0.7%, because that is our historic growth rate, actually. And we sort of think it's sensible to think that, well, maybe nothing changes. Maybe the 10-year growth rate that we've seen historically in both of these economies continues to kind of bumble along at those rates. And so we add that into our expected return. And then to all of the kind of return buckets, we then add some leverage, so about 1.5% leverage. We know that equity holders tend to do slightly better than kind of GDP growth because they have some leverage inherent in the individual companies. So we stack those returns together, and I think what you can see from the chart is that, yes, the US has a higher growth rate than SA. It's actually a much higher growth rate. All else being equal, if we assume that continues, what we can show from this is that is compensated on day one in terms of the valuation of those assets, in terms of the starting yield on those assets when you're building up your kind of expected return. What I do want to say about this graph that we've put here is it's very much a kind of all else being equal chart. And what that means is we've put in no impact for re-ratings. So we know the S&P is on kind of 27 times historic multiple. It's an enormous multiple. And the SA Inc. is trading on roughly half of that. So what this just assumes is that those real returns over the next kind of 10 years is going to see no re-rating in those markets, simply that they maintain their ratings. And that is what you can expect to achieve as an equity holder in real terms if you hold these different markets. So compare that to the kind of real yields we're getting offered in inflation linkers at about 5%. We can actually see that we do get a real yield pickup on SA assets and also in terms of the SA small caps. If I just kind of take a step back and say, well, what happens if we do get a re-rating? What if we do get a normalization of those multiples? So I showed you in the previous charts that this dispersion between the differential in valuation on the S&P and South Africa hasn't necessarily always been the case. And what happens if we start to see that very high rating in the US derate to more average levels? So let's take the S&P down from a 27 times multiple to a 19 times multiple, which is the historic average. And actually, let's be a little bit more punitive in South Africa, because I don't think that we are an investment house that is really looking for very high growth rates to come out of South Africa. And if we're not looking for very high growth rates, potentially we're not going to see ratings on the FINDI and the small caps go back to where they were historically when investors were expecting high growth from South Africa. So let's just see if we have a mild re-rating. In this instance, we take the FINDI from the 12 times that it's currently sitting at to a 14 times multiple. As a matter of interest, the historical average has been 15.6 times, so it's well below its historical average. And in the small caps, we just re-rate them from that 10 times multiple to a 12 times multiple. So if we consider some normalization of the ratings across these different markets, we get quite a different earnings profile. In the grey bars, we've done the kind of 10-year real returns that you can expect. And then we said, well, actually in equity markets, what often happens is that you see these re-ratings happen quite quickly. So let's assume the re-rating happens over the next 5 years. Then you get quite a large dispersion in terms of those real returns. The S&P down 1.7% real, and then the SA FINDI up 9%, and actually 11% real returns you could actually see in the small caps in SA if that were to happen. That's a very, very high real return. So what have we done in terms of our balance funds? We have seen our SA Inc. exposure tick up slightly. We've seen the kind of foreign equity exposure also tick up slightly over the last year. That's actually just as that the foreign portfolios really start to deliver good returns. We've slightly increased our bond weighting using some of our kind of money market and cash weightings. As Farzana said, with the inflation-linked bonds offering such good real returns at the moment, we think that actually those cash balances look less attractive on a relative perspective. And so within that government bond weighting, as I said earlier, we've probably gone from about 50-50 nominal to inflation linkers more towards the kind of 2/3 inflation linkers over that period. And then in the SA equity funds, well, we've really increased that SA Inc. exposure. So we saw SA Inc. Equities really rally post the election in May. And actually, we saw this big kind of re-rating towards the end of 2024. And actually, the year to date, we've seen a lot of those valuations come right back down to where they were. So over that period, we've been increasing our weighting into SA Inc. We're now sitting at around 57% in SA Inc. We have taken our overseas exposure down quite considerably. A lot of that has really been in that we had a very, very big Naspers and Prosus weight. Historically, we had very high upsides to our sum of the parts. We have seen Tencent re-rate dramatically over the period. The share price of Tencent's doubled. And so essentially, we've just said, look, we're sitting closer to our fair value. We still think we're going to get good real returns from Prosus and from Naspers. It's still our number one holding in equity funds, a great diversifier for these funds in terms of totally different exposure. But we have taken some of that overseas weighting downwards and a slight decrease also in our cash weighting. This is just the sector positioning in the equity fund. You'll see particularly there that SA Inc. exposure means that we have very high kind of consumer services exposure to the SA consumer. And then you'll see that we are sitting a little bit, we're quite shy of the benchmark in terms of financials. That's not really a bank weighting. It tends to be more that we're a bit underweight the insurers. We actually have decent bank holdings and we're quite excited about those. And then in particular, you'll see that where we are quite underweight is in the precious metals equities. So these are the gold and platinum miners. We're sitting at almost half the benchmark weighting at the moment, which is itself quite high. And I'm going to deal with that in the next few slides. So this is what we've seen year to date from the CAPI index. These are all the constituents of the CAPI index and essentially their year to date returns. What we've seen from the counters is that the year-to-date performance from the CAPI has been highly centered in the precious metals, so in both the gold and the platinum shares. And we've highlighted those here in the blue bars. Some of these shares are up more than 100% year-to-date, a very, very striking rally in those counters, which tend to be quite volatile. And this just kind of shows you that precious metals weighting. So historically, the precious metals weighting has sat sort of around the 5% level, fluctuating up to 10%. But where we're sitting now is at very high weightings in terms of the CAPI. We're sitting at roughly an 18% benchmark weighting in the precious metals miners. And this just shows our Foord equity weighting. So we actually had quite a positive call on gold. We increased our gold weightings in 2021. Again, increase our gold weightings in 2024. And so we certainly have benefited in some of the big returns that we've seen in the gold miners. But at this point in the cycle, we just don't think it's appropriate to have around 20% of our funds in those counters, even if you tend to be quite positive on gold. I would say one of the points for caution has just been that, and it might sound like sort of quite an obvious thing to say, but certainly the starting point and a sense check needs to just be that gold is not particularly inexpensive at the moment. So this is a chart that we show the gold price versus the oil price. It's basically comparing a very speculative asset to another type of commodity that is very industrial. It's not really stored. It's not really speculative. It's really used in the real economy. And what it does show you is that we have seen historically these peaks in the gold price, but often, we see a more normalized price in terms of gold to oil over time. All it's doing is saying, just be a little bit cautious. Gold is particularly expensive relative to its history. And I think, internally we talk a lot about what is the right price for gold. We've got people in the office that tend to be more bullish on gold, tend to be people who think that maybe gold is more expensive. And certainly in terms of the overall economic backdrop, the debt issues that Farzana has spoken about, I think there's certainly arguments to be made in both categories. Hence why we sort of think that we're at the appropriate weighting of around 7 to 8% of the index in these shares. We still don't think that 20% is the correct number. The other point that I just wanted to make, and maybe where we tend to have some skepticism or kind of reality around these shares, is that they are exceptionally volatile. And so we just show here the real earnings of the precious metals and mining index, and we show relative to that the SA Findy index. So both of these lines are real. We've deflated them. And what you can see as a starting point is that SA Findy kind of ticks along. It does have a business cycle, but you tend to get decent, real, consistent returns out of the SA Findy index. And then the precious metals and mining index has a very volatile earnings profile relative to that. Very big cycles. You can go from earning on this index kind of 400 Rand a share to earning 50 Rand a share within 3 years. So that's significant capital risk that obviously we as portfolio managers are responsible for protecting against. And the important thing is that over time, actually, because of the very consistent earnings that have come out of the Findy, and even more importantly, the very consistent dividends that have come out of the Findy, what you can see is that the real returns out of the Findy has significantly outperformed over time the precious metals and mining index. So we know that these metals, that these miners have very volatile earnings profiles, very volatile margins. What that tends to mean as well is that many times you don't get a dividend at all. Oftentimes they do a lot of rights issues, actually. In actual fact, they ask shareholders to put money in. And so because of that lack of steady compounding dividend yield, you also get a real return that might not be what you would like in terms of the comparatives that you can invest on the index. And so this is just why we have kind of, I would say, some skepticism with regards to these and just some caution with regards to weightings in the portfolios, even if it is a cycle that we do think might be worth playing. When I look at the Foord Equity Fund, the top 10, actually very excited about a lot of these names. So we've spoken a little bit about Process. We still think we're going to get good, real returns out of that business despite the re-rating that we've seen in Tencent. We still like that it's a diversifier from many of the other positions in our portfolio. When we look at the likes of Standard Bank and Netcare, very inexpensive businesses, we think we can get 20% IRRs out of both of those businesses as they kind of deliver, between 10 and 20% earnings growth over the period, actually kind of mid-teens. WBHO has been a business that has contributed, I think, significantly to the equity fund returns over the last 2 years. This is a business which seems sort of counterintuitive actually for us to hold, considering that we've spoken a lot about the gross fixed capital formation in South Africa being at very, very low levels at the moment. What we've seen out of the construction guys is really quite a quirk, and what it really relates to is that the supply side of the construction industry has really been decimated. So very few big, large cap construction businesses left in South Africa. Many of them have diversified their businesses outside of South Africa or closed them down or shrunken to a very small size. So what we're seeing on the index is that only really WBHO and Raubex have the balance sheet sizes to really take on these very significant buildings and civils projects. And as a result, despite the fact that the overall investment and infrastructure spend in South Africa is very low, these businesses are seeing their order books and pipelines growing very strongly. So WBHO just reported results, their order book growing at 23%. We think that they can grow significantly from a revenue perspective, and actually that we've still got some kind of margin accretion to come. So lots of very, very attractive opportunities here. These are not expensive businesses. We think that even in this low growth environment, we actually think we can get very, very good real returns. And we're actually very excited about SA equity returns, I think, which is not really the conventional wisdom of what we're seeing in the market out there.
Thanks, Nancy. Now, I just wanted to mention that I believe we've had some technical issues on Zoom and that we lost the feed for some time. So apologies for that. We do have a YouTube live feed as well. So if you look under Foord Asset Management, obviously Foord Asset Management, you can catch the YouTube live feed, which I believe has been constant. So I'm not going to risk the poll because, of course, you wouldn't have had the entire feed on Zoom either. I think I'm just going to jump to some questions. One of the questions that I just wanted to ask you, Farzana, is about what we would want to see in terms of structural reform for us all to be a bit more positive about South Africa's broader economic growth trajectory. What are we looking for there?
Yeah, so I think, Linda, on that, I would say 3 areas stand out. Firstly, energy and logistics has been the biggest drag to growth over the past couple of years. And I think if we can see meaningful improvements there, it will go a long way in restoring confidence. And both of these areas need a lot of investment, and the government's budget is constrained. So, we need to see more public-private partnership on private generation, transmission, spending on the rails and ports. And we're starting to see a bit of that, but I think we need to see more momentum. Then secondly, I would say we really need to see some meaningful improvements on the fiscal situation. So we need to see spending shift more from consumption to more growth-oriented investments. We need to see them deal with these loss-making SOEs, restructure them, partner with them. And then we also need to broaden the tax base. We can't rely on this tiny pool of taxpayers. So I think if investors can see that debt is on a credible path, then risk premiums can compress, and then we can start to see some capitals flow into South Africa. And then lastly, we need a more supportive business and labor environment. So more policy certainty, simpler regulations for your small companies, flexible labor framework. All of these will go a long way in unlocking private sector investment. So I think any reform that unlocks productivity and restores confidence is what will move the needle on that.
Now, Nancy, I think any conversation about South Africa would be remiss if we didn't talk a little bit about politics. At Foord, we are differentiated, I believe, from many other asset managers who don't think as carefully about the political landscape. And of course, during elections, we had a lot of information coming through on the polling, and we brought in political analysts, and that gave us the opportunity to actually increase our SA Inc. exposure before it was announced that the GNU was going to be put in place, and that was very much to the benefit of our local equity investors. How do you feel about how things are tracking from a political perspective at the moment?
Yeah, Linz, I think that it was actually interesting to note that we saw that recent poll that was sort of leaked from the DA to say that the ANC has fallen below 30 and that the DA has ticked up to kind of the 28. So actually that those two big parties are kind of within reach of each other. I see that Helen Zille said, look, there's a margin of error, and she kind of poured cold water on it. But it does seem to us that is the directionality that things are sort of are trending in. I think that at the moment, our base case is that the next big kind of event is really the 2026 municipal elections. We're going to get really interesting results out of that. Also on that DEA polling, they said that a lot of those Gauteng metros might be in reach. I think it's unsurprising for any of us who've visited them recently to see why. I think that just the infrastructure destruction that you're seeing, and actually so many of the taxpayers leaving those big metros is a big issue, and that those signs are obvious to everybody. So that's going to be, I think, that's going to really set the stage, I think, as a next big kind of watershed event. The other thing that we've noticed is that, and one thing we've been talking about for some time, is we talk a lot about infrastructure investment in South Africa. But about a third of the infrastructure investment that comes from government actually comes from municipalities. And we've seen very, very big underspend in these municipalities, as is evident when you kind of go around. A lot of it's misappropriation of funds, very poor management, a lot of the times not even spending the allocations that national government has given them. And so another key development might be this bill that our Minister of Cooperative Affairs and Traditional Government, I always get this wrong, has brought, Minister Klebisa has brought to say that, he is proposing a way of dealing with these underperforming municipalities. And that's going to be brought to Parliament next year. So I think that's also going to be kind of a key development. All that being considered, even if we do see these support levels of the ANC continuing to dwindle, I would say that we think of South Africa as Foord having the potential to be a very high growth economy, the potential to be a very low growth, negative growth economy, depending on the politics. But the base case probably is that we continue to kind of bumble around where we are at this point. I don't think any of those things are sufficiently game-changing to move that number. So the way we look at it is we need to kind of build those kind of very anemic growth rates into our models in terms of when we are pricing those assets. And I think, I think that kind of is where we haven't markedly changed that opinion.
Okay. All right. Thank you. Unfortunately, that is all we've got time for today. I'm just going to give a very quick recap, just especially for those who may have lost us for a period of time on Zoom. There will be a recording that will go out as well, so you will be able to catch the full webinar through the recording. But just to summarize some of the points that we've made today, to make sure that you take those away with us, with you rather. Farzana first spoke about how both the US and South Africa, and in fact many other governments around the world, are grappling with dangerously high debt levels and persistent fiscal deficits. The era of ultra-low interest rates is over, so debt service costs are now materially squeezing budgets. And in the US, even the safe haven status of treasuries and the US dollar is being questioned. And we're definitely seeing some signs of stress in those markets, which have typically been considered very safe havens, and of course, much more typical of emerging markets, where even the dollar is being sold down when there's a risk event. In South Africa, debt has ballooned sixfold in 15 years. We've had weak growth that's made debt stabilization very difficult, and debt service costs are now consuming 22% of tax revenues. Long-dated nominal bonds for us look unattractive for some of these reasons, and we do think there are some risks, and valuations have run hard. So we believe that there may be some downside risk from here, but we are seeing exceptional value in shorter-dated inflation-linked bonds, where real yields of around 5% obviously offer you capital protection should inflation trend higher, especially as we think it will do, which makes them a very rare, compelling opportunity in a world of fiscal fragility. So in terms of our positioning in fixed income, we're cautious on long-duration bonds and credit, but we're very constructed on inflation-linked bonds. And if you want to access that directly, you can, of course, use our inflation-linked income fund. Turning to Nancy's part of the perspective, with inflation links offering 5% real, it's quite a high bar for equities in terms of the high hurdle that they have to clear. But the good news is that we are finding some opportunities on the South Africa Inc. side as well. South African equities are undervalued, especially relative to global markets. And of course, foreign outflows have been part of the reason why they are so. But valuations are offering much better opportunities than in other parts of the world. So within South African equities, we're seeing some strong opportunities in some quality industrials, some select banks, and some of the more locally oriented consumer names as well. Importantly, we're finding a lot of attractive opportunities in the small and mid-cap space. And being a mid-sized asset manager, we can really delve into the wide opportunity set and take meaningful positions there, which I think is a differentiator for us. Globally, though, the opposite holds. The US equity markets still looks very stretched. It's trading at very high multiples, which means that we have lower expected real returns from that market. We are finding value in other parts of the globe outside of the US. But Foord's local equity funds are overweight SA Inc. names. We're very cautious on resources at this point in the cycle, and we focused instead on those businesses where we can find consistent earnings and dividends in terms of their long-term earnings profiles. Importantly, I think Nancy and Farzana both highlighted how we need discipline in this environment, that we need to avoid overpaying for risk, make sure that we are always thinking about how to preserve capital, and look for opportunities where the valuations or the price that we're paying stacks the odds in our favor from this point onwards. So despite the challenges of today's economic backdrop, the South African investment landscape does still offer many different ways to build resilient, future-proof portfolios that can deliver the inflation-beating returns that you as investors require without risking capital in the process. So thank you, Farzana and Nancy, for your insights today. To everyone that's joined us live, Just a quick reminder to fill out the survey that pops up when you leave the webinar. I also just wanted to mention that we do still have capacity in our 3 fixed income funds where we are able to provide very, very low founders fees for those investors who are able to invest directly. Now, these are the types of fees that would only be available to very, very large institutional investors. So I'm talking about 0.2% flat fee for our income fund, 0.25% for the Flex Income Fund, which Farzana spoke about. So if you'd like to take advantage of those, please do speak to your relationship manager or get in touch with our unit trust department as well. So thanks again, Nancy and Farzana, and thanks again to everyone who's joined us for this session today. Take care.